All right, and we should be live now. Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. I'm joined here with many of Thoughtful Money's endorsed financial advisors. These are the firms you see with me on this channel week after week. I'll introduce them in just a second. This is something that we have done in the past, and we're going to try to be a little bit more dependable about doing it on a monthly basis going forward. But a big part of this channel is not just to help educate people, but to help them take action based upon that information so that they can be investors, regular investors like you, can be making more informed decisions about your wealth. So, of course, I bring on these big experts every week so you can crawl inside their brains. But I know that oftentimes creates a lot of questions that you have. And so these Ask Anything sessions with our financial advisors are the forum where you can ask whatever questions you want of our endorsed advisors, and they'll do their best to answer them for you. So that's what we'll be doing here for this next hour. I'm joined as usual by lead partners from New Harbor Financial, Mike Preston and John Llodra. That's a US-based firm. Our other US-based firm is Lance Roberts, who wasn't available to join us today. We also have a Canadian firm. So we've got Jonathan Wellum there as the head of that firm. That's Rocklinc investment partners up there in Canada. Gentlemen, thank all of you for joining me today. I'm going to just start running through questions here. So we'll go hot right out of the gate here. I've had a bunch of people send me questions in advance. I'll start with one or two of those, and then folks watching live, I'll then start pulling as liberally as I can from the live chat there. Folks, just make sure that if you've got a burning question, ask it there, and I'll try to do my best to either pull that individual one in or try to combine, if there are many that are on a similar theme, I'll try to combine them into hopefully one question that can answer many of your inquiries. Well, gentlemen, thanks for joining us. Why don't I start with this question here from Chris Yerrington. He says, how can I stay in a market at an all-time high valuation? In recent videos here, I've been showing something called the euphoria meter, which shows that it's a measurement of forward PEs and the VIX and a few other things. In the 30-plus year data set of that euphoria meter, we are at an all-time high here. I've talked with, I think, each one of you firms at times on the channel here about how, depending upon the valuation metric you use, markets are either at very highest extremes versus historical averages, or in some cases, the highest they've ever been. So I think this question that Chris is asking is probably on the minds of many folks watching here, which is, how can I be along this market without feeling like I'm the greatest fool getting in at the last minute? Jonathan, why don't we start with you on this?
Thank you very much, Adam. Yeah, good. It's a great question. It's one I think that probably all the advisors struggle with. And there's no question it's euphoric, the marketplace. So I agree with all of that. The way we go about it is that we are value investors and we are buyers of specific businesses. And so what we need to do is trim businesses that are trading at higher valuations and try to look for companies that we think are trading at much more appropriate valuations, maybe overlooked in the marketplace or in sectors that have not performed as well. And so that's what we're spending a lot of our time doing. We do also carry typically about 25 to 30% cash / short-term investments, interest-bearing securities. So yeah, the name of the game for us is rebalance, find the companies that are better valuations and be very careful because the market is expensive and could be subject to a substantial drop at any point in time. Now I'm coming from Canada, and so looking at the US, I might say right off the top, this will probably get all sorts of questions. I certainly am more enthusiastic now that you're going to have a changing government. And I think the new government will be much more favorable to the capital markets and quite different than what we have up here in Canada, which is a real stress on our capital markets.
Okay, John and Mike, I'm going to give you guys a chance to chime in too. I think we've got so many questions that we'll probably switch pretty quickly into me just directing one question to one of you going forward. But there are a few like this that are overarching, and I'd love to get all your opinions. So, John, why don't we start with you here? Anything you would add to Jonathan's answer?
Yeah, I guess I would say quite bluntly, you don't need to be fully or even heavily invested in at market highs. This is where it's really important to bring it back to one's own financial picture. Frankly, some people don't need to take the risk to have their financial plan be more than fully intact. And nothing in investing, and certainly in this question, should be thought of as an all or nothing kind of a decision. It really should be brought back to the risk and rewards. And there are ways to deal with this by simply, for example, when valuations get high and euphoria gets off the charts like we're seeing now, it's every bit appropriate to think about scaling back and having a lighter allocation to things like equities across the board. There are tools that can be used that we use quite frequently to hedge risks using options, for example. We were talking a little offline, Adam, with you before we went live here about the cost of buying put options as a protective measure is quite cheap right now because the market is so complacent. So there's a whole host of tools, but I would start with challenging the notion that one needs to be invested heavily or even substantially in the stock market when things get to the levels they're at right now. And it really comes down to, again, bring it back to your own situation.
Okay. Sorry, I'm still getting used to the controls here. Mike, did you have anything else you wanted to add to that?
I don't think so, Adam. I think that John and Jonathan did a great job. Thanks.
Okay. Let me ask sort of a related question then, and this comes from Lawrence Lepard. So he was noting that you guys were going to be on, so he wanted to get a question in here. When does the stock bubble burst? What will be the pin that bursts this? And I'll preface this by saying, nobody really knows, and there's that saying that it's the it's usually a black swan event. And by definition, a black swan event is the bullet that you didn't see coming. It was the thing that nobody expected. So of course we can't predict the thing that nobody's predicting. But if you had to put on your prognosticator cap, what do you think? How much longer can we continue this party at these record high valuations? And when the party starts to end, what's likely to end it? Mike, I'll let you start with that.
Well, as you know, Adam, this is a wild guess. The stock market's been unsupported by fundamentals and valuations for many years. We have reached recently in recent years a so-called permanently high plateau where valuation measures are nearly triple what they would need to be to produce 8 to 10% returns, but nothing's mattered. And so everyone's got the same question. Two questions. Number one, does the market ever reach an equilibrium level again in our lives? And two, what's going to make it go there? On the first question, we have faith here at this firm that yes, this time is not different. The market has cycles and waves, and this time is not different, even though it's more extended than other times. And so therefore, we do think we're going to see a drop in market valuations. And that drop should be at least 50%, maybe 2/3 or more, just to get down to where we would expect normal returns. And as far as what's the pin that pops the bubble, who knows? We've been early. I'll admit it. We've been early. This has just been a crazy time in the market. But I think we're getting to a point where very few people think this market can ever correct again. And that's the definition of a bubble. My best guess is that it's potentially euphoria or enthusiasm that's caused by the Trump win that gives us a final blow off here into the first and second quarter of next year. And here we are at almost 6,100 on the S&P. We might go to 6,500 or more in short order over a period of weeks. I think that would be a signal that would be a perfect signal. If we get a little blow off that's vertical here, that would be a pretty clear signal that the end is near. But I don't really have any other catalyst other than potentially Trump enthusiasm.
Okay, I want to dig into that a little bit, but first, we just had somebody actually pay. I didn't realize they could do that here, so it's wonderful that they did, and thank you so much for supporting this channel, who just paid to ask this question. What's the best way to play a VIX volatility spike? So obviously, if things started getting a little bit rocky, you would expect volatility to go up. VIX is a measurement of volatility. If you were thinking volatility was going to go higher and the VIX was going to go up, what's the best way to play that? Jonathan, we'll go to you.
Yeah, I'll be real honest with you, Adam. We don't really, preoccupy ourselves with the VIX and volatility. Obviously, it's a measure of risk of volatility. We would then be looking at precious metals and areas to invest in that area, try to get an offset. But in terms of using any kind of derivatives, any other kind of structure, that's not our game. And so I'll hand it over to Mike and John, who might have another idea on how they'd want to play that. But it's not something that we do as long investors, sort of value investors.
Okay, gentlemen.
Yeah, so we wouldn't ordinarily suggest chasing or playing VIX in and of itself. It's a tricky thing to do. However, one of the key inputs to option pricing is implied volatility, market-wide and certainly within individual stocks. So volatility and a spike in VIX is supportive of you want to buy options when you buy put options, for example, when volatility is muted. And all else being equal, a spike or expansion in the VIX will also cause an increase in the value of those options. So, generally speaking, it's very simple to say this, but you want to buy options, buy volatility when it's low, and sell options when it's high. Okay. Now, I think implied in the question probably is a notion that stock markets and stock market sell-offs and VIX spikes go one hand in hand with each other. So, for example, when you see the stock market sell off, it usually is accompanied by a spike in VIX. So we would say that the right way to play a spike in VIX is another way of saying getting defensive about equities. So either selling down exposure in equities or using put options like we just talked about to protect on the downside. We wouldn't ordinarily suggest going out and trading VIX directly. There is the difference between spot VIX and VIX futures, and there are all kinds of stories about some of the inverse ETFs in there that track the VIX space and the tracking error. We've seen so many people blow themselves up with those kinds of plays that we certainly would not recommend it. So indirectly, we would say best way to play volatility spike is by getting defensive in the stock market, either selling stocks or buying protective puts, for example.
Okay, and of course that's more of a lower risk defensive way to play against market volatility. For somebody who was speculative, and I don't think any of you are recommending that people go and be wildly speculative right now, but that person could play the VIX, as you talked a little bit about there, John. I just want to get this thought on the table because it's a conversation I had the other day by somebody who was looking to play volatility, to be speculative, saying that, hey, I think volatility is going to increase. I think it's going to make market prices go down. I want to try to play that. One of the ideas that we discussed was, Bitcoin is, I don't want to get into the discussion of the long-term value of Bitcoin, but just from a correlation standpoint, it's one of the most speculative assets that are out there, right? As speculation increases, Bitcoin price increases right along with it. And then you have, these companies like these stocks like MicroStrategy that are essentially leverage plays on Bitcoin. So if you really were expecting a big market downturn and you wanted to be speculative, again, with money that you could afford to lose if you were wrong, would MicroStrategy, maybe shorting that, be a way to play for a market, to speculate for a market downturn?
Yeah, Adam, if you wanted to speculate on a market downturn, I would just buy long dated puts on the S&P. If you take those things that I just put out there a little while ago, expecting a 50 to even 60 or 70% decline, you can buy puts on the S&P 500 going out almost 2 years. To January 27. And it costs I was looking at it the other day for somebody, it's like 7% or something like that. So to buy puts on $1 million, to use a big round number, would cost around $70,000. If it was 100K that you wanted notional exposure to, it would be around 7,000. And if you only wanted 1 year to January of 26, it would be 5% or 5,000. So in general, we don't love the idea of buying options because you're paying premium and then you lose time decay as time goes by. But when you buy options like that, they're almost tailor made for big moves. So if what you think is a big move, you could try to play the VIX like you just asked. It's pretty difficult. There's a thing called the term structure of VIX, and it's very contangoed. And so you're going to lose money every month that you're buying VIX options because the front months are The front months is like around 13 or 14 on VIX right now, but I'm looking at the term structure, and I could share this chart up if you want, but there's something called VIXCentral.com, and going out like 2 months, the VIX is 17. So you're buying options at 17 and then they're dropping to 13 over the next couple of months because that contango, that term structure is coming out. So it's pretty difficult to do. I would personally, if you think there's a big drop coming, start layering in maybe slowly dollar cost average into positions, buy some January of 27 leap options, pay 7% of the notional value and define your risk before you put it in. Whatever money you put into the option, you might lose it all. So that's defined risk. So, you can come up with a strategy like that. I think that's going to start to make sense, because even if this market goes higher by 5 or 6 or 7%, we think it's going to drop hard next year.
Okay.
And Adam, I'll just quickly comment about your specific question about using MicroStrategy as short on that we would highly recommend against that. Using a surrogate that is in theory completely unrelated. It's related in the sense that it's we think caught up in a speculative fervor for a whole bunch of different reasons. But we think that could be absolutely dangerous to, for example, short MicroStrategy on the assumption that it's a good way to hedge a spike in VIX or a broader decline in the market. Yeah, in theory, maybe a sell-off in the market causes some of the speculative fervor there, but that thing is its own beast, and I wouldn't use that as a surrogate hedge for anything.
Yeah, I figured you'd probably go there. Yeah. So John and Mike, real quickly, because you guys buy protection as a regular order of business in your portfolio management, you referenced this briefly, but downside protection is quite affordable right now on a relative basis. In your guys' career, like, what's the level of affordability right now? Is it one of the best pricing environments you've seen for purchasing downward protection, or are we not, is not quite that material yet?
It's almost there, Adam. It's not quite as low as we've seen it in years past. I remember the VIX getting down to about 9, and the VIX here at 13 is pretty close. I wouldn't be holding out for an absolute low in the volatility index. I don't know if we're going to get there. I would say that this is in the, 10% of the times that I've been in this business, the lowest decile, let's say, in terms of cost of protection.
Okay.
I'll just add, there's been some charts, you may have seen them. You can look at a chart of what the cost of, and there's several nuances here that we need to gloss over. The relative, the strike price, or the in or near the moneyness of the strike price, is going to affect the cost of the puts. But assume that away for a moment. You can look, despite the VIX not being, not quite down to 9, where Mike talked about, you can look at a chart going back many, many years, and it's amongst the cheapest right now to buy put options on the S&P. You can look at it 2 months, 2 years out. There was a chart going around. I don't have it at my fingertips, but it's pretty darn cheap.
Okay. So for those folks that are nervous about today's record high valuations, some of the quote unquote good news is that if you want to buy yourself some downward protection, it's quite affordable on a relative basis. All right, Jonathan, coming to you with this question. What do you think will be the top performing sectors of 2025?
Again, that's a great question, and I always find it interesting that whenever we begin the year and I try to identify the best sectors, typically, you're not necessarily all that close.
It's usually something else, yeah. But your best guess right now.
Yeah, I think that some of the areas that I think should do quite well. I think the manufacturing sector could do quite well with some of the changes that are taking place. With Trump and maybe more capital accumulation and investments back in those areas. Technology, which has done very well. I think you need to be very careful, but that's where a lot of the growth is. And so I'm not talking about buying the Magnificent Seven per se, but below the surface, there's other companies in that space that are doing exceptionally well. And I do believe that even if the price of gold and silver remain where they are, even if they pop up just a little bit from here, I think there's still a lot of opportunity in some of the mining companies, and not necessarily directly the mining companies, but some of the royalty companies that have not actually performed that well. I think there's a lot of potential upside in some of those stocks that have lagged the actual underlying commodity. And if oil prices, which I believe could remain quite low and even go lower if there is less regulations and there is more drilling and more emphasis on production, and less hindrance by the state, which we've even seen up here in Canada. That can be changing also. Then that'll also help in terms of the cost structure and some of the mining companies and the profitability.
Okay, so I'm just going to let you comment on this then, Jonathan. Sean asked, countdown to my gold miners. So it sounds like somebody who probably holds some gold miners, as I've been saying, when are these things going to start taking off? I know that your firm is actually with all of you here, New Harbor and Rocklinc. I know that gold miners play a material role in your portfolio allocations. I think the difference between your two firms is New Harbor, you guys tend to go after the beta by playing the ETFs. And Jonathan, you tend to go after the alpha by trying to identify kind of the cream of the crop and invest in companies that you watch very closely. So,
right.
When are you sort of expecting, and I know you're having to guess here, but when are you sort of expecting that the miners may actually finally come into their own here?
Well, I do think if gold and silver remain at these levels and even poke a little higher into 2025, I think it's really the sustainability of the prices. I think then many of the miners will respond over time, but we need to flow into them, into the miners. I do, even though we don't buy a lot of ETFs and index type funds at all. This is one time that I would suggest that if you could find a nice little ETF that could buy some of the juniors and give you more diversification, I think that is actually a wiser way to go in, unless you really are doing a lot of analysis on individual companies and you understand them well and you understand all the players in the business and the geology and so forth. I think in this case, there's a number of really good ETFs that you can buy that'll give you a basket of miners, because the business is so tough. It's so hard to predict. And buying individual miners, again, unless you're really unique and are prepared to buy a basket anyway. I mean, very few people can just identify one company and do exceptionally well. I do think you need to have a number, because the area is so volatile, it's so unpredictable, and there's so many things that can go wrong, even with great mines. And so that's the way I would approach it. And I do think that there would be some upside. We use a couple of the Sprott ETFs where they try to identify what are some of the better miners, ones with better balance sheets, more cash flow opportunities, good political jurisdictions and so forth. I think that would be the way I'd go if I were actually buying a lot of miners.
Okay. And I'm just curious, Jonathan, gold has kind of been in a sideways trading range here for a bit. One of the things that clearly seemed to have driven the price higher in the past recent years has been central bank buying of gold. China had been taking a pause on buying gold. It just was released, I believe, yesterday, that they've started buying again, at some material volume. Do you expect to see any sort of positive repercussions in the gold price? I mean, I guess today, as we're talking, gold's up an ounce or so, right? So,
I think those longer term trends are going to continue, and that's just because of the global, the geopolitical situation in the world, and also the debt situation. You asked earlier what could cause an unwinding of the markets, and I think one of the issues. It's not the only one, but it's just this massive debt overhang we have globally and across most of the industrial world, the strongest countries. So I don't have to tell you in the U.S. that you got $36 trillion in debt, and the deficit is 6% of GDP and so forth. And there'll be some changes, obviously, with the new administration, but it's going to be very difficult to wrestle that down. And in Canada also, we're running large deficits, massive amounts of debts, personal debts, and so forth. And I think the run up in debt over the last 30, 40 years is going to come back and haunt us at some point. And so I think people need to be prepared for that. And that's one reason why I think gold, silver, the precious metals, they are typically a hedge to some monetary crisis and so and debt crisis. So I think that's one of the reasons why they continue just to ease up, to move up, I should say. And the central bank purchasing, again, is just trying to align currencies. Obviously, there's been some concern amongst the BRIC nations with the U.S. government's policies and sanctions and so forth, using the SWIFT system to weaponize the dollar. And so that, again, I don't think is necessarily going to change in a dramatic way going forward. And I think the countries are going to continue to want to accumulate some gold.
Okay. I'm going to come to this next question about TLT. John, I'll ask it of you. Real quickly before I do though, folks, just in the comments in the live chat right now, if you can, just let us know how you're enjoying this format. Is this something you would indeed like us to do more of going forward? Again, the current plan right now is to start doing this consistently on a month-by-month basis. And obviously we only want to do that if you like it. And if you do like it, of course, we'll do it. But if you don't, we'll do something else. We'll do whatever else you prefer. All right, John, here's the question. TLT, and for folks that don't know what TLT is, it's an ETF that that owns long-dated U.S. treasuries. I think the average duration is about 20 years for that fund. Are we at a moment where you buy it, you hold it, or you sell it? And then Stephen also asks at what levels. I'm not entirely sure what he means by that, but if you think you know, John, feel free to answer.
Yeah, so TLT, as you said, Adam, it's a exchange-traded fund that tracks 20-plus year U.S. Treasury bonds. So they're longer term, longer duration Treasury bonds. Just quick review. Bonds do well when interest rates decline and vice versa. So the key question here is what's likely to happen to interest rates. Big picture, it's kind of a split picture, frankly. One of the big, so I'll just remind folks that even though the Federal Reserve started cutting rates for the first time in quite a while in September, they started cutting rates at their September 18th meeting. So they've dropped, I think, 75 basis points so far from the peak, and are expected, I think, with a 70 or 80% chance at this moment, to drop another 25 basis points, 0.25% at their December meeting. But over that time, yields on longer term bonds have gone higher. And I can pull up a chart here in a moment if it makes sense to. But so what has happened, and many people were confused by that. Why are bonds selling off even though the Fed is dropping rates? And the key there is that the Fed only controls the very short end of the curve. And actually the longer end of the curve has been affected by many, many other things, including concerns about budget deficits, which have gone off the charts. And remains to be seen what kind of spending cuts and things like that can be achieved under the new incoming administration. But that has been a key factor. People are getting very worried about the U.S. budget situation here. There's a maturity wall of debt coming due over the next few years. So simple supply and demand. There's going to be a whole bunch of new debt issuance that, all else being equal, will put upward pressure on rates. So that's a big question mark. Now, in a real risk-off scenario, we think there's a good chance that despite those concerns, investors flock to the safety of Treasury bonds, and we see those yields come down. Tying in the discussion with gold, many central banks across the world have decidedly, shifted their reserve policies to hold less U.S. dollars and U.S. Treasuries, and very, very intentionally increase their gold allocations. That's something that has been a strong trend in recent years and is expected in the years to come. So there's a bunch of macro factors that are affecting the longer term bond market. But if I can share my chart here, let's see here, share screen. I guess you got to enable it, Adam. I think. Let's see. Oh, I got it right here. So here's a chart of TLT. This is a daily chart. You can see it got as high as 101 and change back in mid-September. That's literally the day that the Fed started cutting short-term rates. So that those bonds have sold off almost without pause. There's been a very sharp bounce here, but here we are. We're kind of in between the 50-day moving average, this green line, and the blue line, which is 200-day moving average. We're kind of in a real key technical support area here, or technical proving ground. Frankly, we have a very small allocation to ETF like this, TLT and some similar ones, about 7.5%. And we're probably going to look for, if we get some strength into the mid-90s here, to actually put some hedges on that, because this is a pretty significant area of resistance we think will emerge here in the short term. So I don't think it's a time to be plowing in a very large size on this thesis that it's going to shoot higher without pause. We're in a very tricky time here. I would keep position size small, but certainly on a breakout above the 50 and 200 days here, that would be a little bit more of a green light to think about the path of least resistance in the near term, anyways, are yields dropping and an investment like TLT going higher. Of course, no guarantees, but that would be a fair way to read those short-term moves.
All right. Great, John. And thanks for bringing the charts up there too. We're getting the hang of the multimedia aspects here slowly, but we're getting them. All right, Mike, I'll come to you with this question. This is another paid question from an audience member. T.A. Chapman asks, we've heard doom and gloom for 2-ish years. Is this a reflection of the 2005 to 2007 period? And if so, how bad do you think things will get? I guess his reference to 2025, 2007 was everybody thought everything was just going to continue getting better during that period. And it did right up until the wheels came off. So I guess he's asking, are we in a similar situation here? And if so, what do you think the unwinding could look like?
Yeah, I'm just not sure what they mean, what TA means by doom and gloom for 2 years here. We haven't heard, maybe it's been us that's been talking about doom and gloom.
Yeah, I'm going to guess
know.
he's saying, because I hear this a lot in comments, that hey, a lot of your speakers keep saying that, the market's going to crash or all these macro issues that they're worried about, and yet the stock market's done nothing but, be on fire for the past 2 years.
Yeah, I remember. I mean, John and I were in the business. I'm sure Jonathan was in the business too during that time. The 2005 to 2007 timeframe was a time the market just was pretty relentless. Very little pullbacks, very little chances to get in. It was very frustrating to be a manager at that time. And yet you could see the housing bubble building all around you. And it didn't matter until it mattered. And I'm still not even sure what exactly the catalyst was to start bringing that market down. We had Bear Stearns first. I think that was in the spring, and then Lehman Brothers in August and September really kind of got it going. But, back then, there was a lot of things to be concerned about. You just got to remember that the whole last 20 years or so, 25 years now, has been bubble, crash, rescue, bubble, crash, rescue. The market has not really been able to fall back to an equilibrium point. The Fed will not allow it, or has not allowed it until now. And so, yeah, it was frustrating to be a manager. I don't remember a lot of doom and gloom back then, other than we were out there saying, look, valuations are crazy. Our indicators are starting to roll over. We lightened up some. And we were pretty young in the business then, but even back then we had, a system that was telling us to be careful, and we were. The difference this time is our system has been telling us to be careful for more than 5 years, right? And this time, as I said earlier, has been different in that it hasn't mattered for longer than I think any other time I can see in history, and I study history a lot. So, yeah, it's been us talking a little bit negative. We've tried not to be too doom and gloomy, and we're roughly 43% in stocks now, and have been all year. And a good part of last year, we're not net short. We never went net short. We just don't see how history ends any different this time. These cycles go in waves, like sine waves, up and down, like clockwork. We're deep into what we think is a fourth turning. How can we not warn at least a little bit? So try to look at the silver lining, in that there'll be a lot of opportunities after all of this. So we here at New Harbor have accepted a lighter equity allocation than our peers. So be it. That's caused us to underperform a little bit as this bubble continues. But, I don't think that this is a big rhyme to that time. I just think this is the third and biggest bubble in the last 25 years. And I've got faith that it will resolve to the downside. And those warnings I think are going to mean something. But, it's very frustrating because, why not just get out or get short? People are asking about getting short. That could work. I don't know. What we're doing here is we're 40% with some pretty good hedges down very close to here, 5,800 on the S&P, and we'll let the market take us out when that happens.
Okay. And Mike, so let's assume for a moment that the market corrects in a way that you think it should, given today's levels of valuation or even overvaluation. What sort of magnitude correction are you looking for, to the spirit of TA's question here?
I think we go down more than 50% in the next year. That would be pretty crazy, wouldn't it? But that's what happened in 99 to 2000, or I should say 2000 to 2002. That's what happened in 08 to 09. And I think that's what's going to happen here in 25 to 26. I don't know exactly what the catalyst is going to be. Like I said earlier, I think it's going to be one final bit of euphoria related to the Trump nomination. And I think we lose more than 50% on this market. Now, that doesn't have to happen, and maybe it won't happen. Math and history says it will happen. We've all had egg on our face here at this firm in terms of warning people for a long time, and nothing's happened. But that doesn't mean it was wrong to do so. That just means that the policies are so extreme that they've been able to forestall the inevitable for longer than ever possible. So that's the way we see it.
Okay, and I'll mention it too. I was just talking with Lance Roberts about this over this past weekend in the market recap, and he mentioned that if the market were to correct by 50%, he's not calling that for it to do so, but he said if it were to, it wouldn't technically break the bull channel that the market's been in for the past decade plus. So even though it's a colossally big percentage decrease, it technically wouldn't kill the long-term bull channel that we're in, meaning, it would take something even more than that to put us into a sort of a true bear market state. Jonathan, I got another question for you, but anything you want to say about this before we move on?
Were you referring to me, Adam?
Yeah. Sorry, you're Jonathan. He's John.
No problem. No problem at all. No, I would just say that, look, whenever you're going into the equities and you've got valuations where they are today, investors have to be prepared for a 50% drawdown. That's just, we tell our investors, they come in, we say, look, we're not predicting that at all, but that's the way equities can trade. We, of course, are trying to, protect investors as much as possible from downside and trying to, again, continue to capture the upside. But anybody who doesn't think the markets can drop by 50% doesn't understand the capital markets. And again, that's not a prediction at all. I think there are good reasons why the market can continue chugging along, but nowhere near the kind of returns we've seen the last 2 years, which is pretty close to 50% if you aggregate both years. That's just... to us, there's no way we'd want to be betting on that. We would be, we're being very careful. Yeah.
This is not the question I have for you. I'm going to ask it in a second. But, I was at a family Thanksgiving dinner last night, and a family member had a good year in the market, and was talking about kind of arguing with their spouse about, hey, I made this much in the market. Like, let's put a lot more in now, right? And one of the things about bull markets is their job is to suck in everybody right from the sidelines. And we've seen some pretty big capitulations, like even a very, very stalwart bear, David Rosenberg, published a piece recently, not necessarily capitulating fully, but saying, hey, it's time for me to admit this hasn't gone the way that I thought. And, a lot of people are looking at that as a sign that all the bears are throwing in the towel here. So my point is I think sadly, and this tends to be the case at a lot of market tops, we could be seeing that period of time where, the casual investor who doesn't really understand markets nearly as well as most of the people who watch this channel is now finally saying, okay, look, it's easy money in the stock market now it's time to pile in. And none of them are thinking, I don't think any of them are thinking about the possibility of potentially losing half their money in the next year if we were to get a correction like this, right? And that's kind of the danger you have when times get really good like they've been right now, correct?
Absolutely. Warren Buffett mentioned at one of the annual meetings I was at, he said, what the wise person does at the beginning, the fool does at the end, right? And we must be really, really careful. Envy and greed can get us into a lot of trouble, fear of missing out. And that's why again, from our perspective, we're not trying to make calls that are absolute, like the market's going to drop, it's going to go up. We're trying to buy in businesses and investments that are reasonably well priced. And when things do get expensive in the market like they are today, we back off a little bit. We still got lots in the game, but we back off a little bit, carry a little bit more cash. Market were to go down quite a bit, clearly that cash would disappear very quickly. Right now, though, if we can collect 3, 4, 5% on the cash, that's not a bad thing too in this market. And so again, we're just trying to be balanced. But all of our investors are told, look, the equities can drop 50%, and you have to be prepared for that, or you should not be investing in the equities. If you should not go into equities unless, from our perspective, as longer-term investors, you can take a 3 to 5 year perspective on this thing. We're not investing for the next 3 weeks or 3 months.
All right. And I'm glad you mentioned that. That's something the guys from New Harbor mention a lot too, is, What do you say, John? People retire hopefully for the rest of their lives, right? You're not trying to make short-term decisions here. You're trying to make decisions that will set yourself up for the long term. Okay, so Jonathan, here's a question for you. We had JH here who wasn't entirely sure we were doing a live stream here. So he said, hey, if this is a true live stream, what do you think about oil? So I want to prove to him that indeed this is being recorded live. And I know that oil is one of the sectors that you look at up in Canada there, Jonathan. So what are your thoughts there?
Yeah, I mean, we do. And we think that oil and gas, of course, are going to be wonderful long-term places to be in terms of the demand for them. We don't think that, again, the green agenda is really going to have much of a dent on the demand for fossil fuels for some time. Our position right now is to be very careful about direct oil exposure. I mean, we typically don't have a large amount, but we might have 6-7%. We've actually sort of taken that down, and that's because I do believe that there will be downward pressure, which is a good thing for inflation and for all the other industries, because of the U.S. emphasis on producing more energy and more oil. And I think that's going to make it more competitive. If we get a change of government up here too, we're going to get more production also. So I think that there could be a downward bias, just a little bit of pressure on oil to be weak for the next little while. And that's largely because of more production. And around the world, there is some economic softness. And so we're just being very, very cautious in terms of energy. What we found out with Trump before was when you're trying to drill more oil and you produce more oil, then prices actually go down. And oil companies did much better when they were actually being attacked by the Democrats. And so we're just being very cautious.
Okay, I will echo that. Your comments are shared by Doomberg. So the folks here that have seen my interviews with Doomberg, who's the energy analyst, very similar thing. Drill baby drill is great for the economy, but it's actually not necessarily proven to be great for the prices of the oil producers. John, I'm going to come to you with this question from Aaron. He's asked the question like a dozen times here. It's a very specific question, and I'm not entirely sure you'll feel comfortable answering it individually on air. This is sort of a individual financial advice question. But if you can, great. And even if not, it speaks to a larger question, which is, how can we help fund the financial futures of our children? And, we're coming up at the end of the year, and there are things like gifting and, potentially opening accounts that would maybe good steps to take before the new year arrives here. So the specific question is how can I fund a Coverdell ESA when you're over the income limit? UTMA transfer to Coverdell. If I give my child money and they deposit, how do you record it as a gift and not me funding it?
Yeah, I'll happily give a broad answer to that question. Certainly, Aaron, if you want more tailored advice to your question, happy to have you reach out to us. But to be honest, Coverdell accounts have all but been overlooked by most people for a number of reasons. One is the income limits that Aaron speaks of, but also there is contribution limits. You simply cannot put that much money into these accounts. And with the way that college expenses, for example, have escalated, it almost becomes a moot issue. It's such a small drop in the bucket that most people even overlook them. More typically, a 529 plan is the more desirable and a place to look for college savings. With a 529 plan, any growth in those assets are tax-free so long as they're used for qualified college expenses. One little kind of nuance of a Coverdell is it can actually be used for secondary school, private high schools and things like that, which 529s can't. So I don't know if that's perhaps the reason for you're specifically asking about Coverdells, Aaron. Perhaps you're considering private school for one of your children. And I frankly can't recall off the top of my head what the income limits are. Not a big fan of UTMA accounts these days. Essentially an UTMA account gifts money to a child, and most parents and grandparents, for that matter, would rather gift money into a 529 where they still retain ownership. And little nuances, they can retain ownership while still having it not count against their estate plan when it comes to settling estate taxes and things like that. So UTMAs aren't generally a favored way, anyways, anymore to gift money to children, in part because they end up being the owner of it, and when they turn the age of majority, can do whatever they want with that money, and that becomes a question about the child and the individual child and how responsible they are seen to be by the the donor. But again, I'm happy to talk more specifically about your situation. But generally speaking, at Coverdell, and I don't know that there's much in the way of gamesmanship that one can do to address the income limits. Again, the contribution limits are quite small relative to the cost of education, so they've become all but a forgotten kind of an account for that reason.
Okay, a couple quick things on funding your child's future. One thing that parents can do, right, is if your child is working, so they're a teen or older, right, they will qualify for a Roth IRA. I mean, as long as they're not making too much, but at this point, we're talking about teens and 20-year-olds and stuff like that. You can essentially gift them. You can make their Roth IRA deposits for them, right, as part of your annual gift allocation to them. So in most cases, the Roth IRA limit's going to be lower than the annual gift limit. So they can work, make money on a pre-tax basis. You can then put your gift money into their Roth IRA and help them build their Roth IRA over time, where they're not having to put any of their own funds in there, correct?
Yeah, that's right. They have to have earned income, though, Adam.
They have to have earned income. Exactly. They have to have the job.
So, maybe they have earned income from some other place, a part-time job or a summer job. And so in the limit this year for Roth contribution is $7,000. So let's say they have $3,000 or $4,000 of income, and they spent that elsewhere. You could gift them $3,000 or $4,000 in that example. They could use that money to fund it, and they would qualify. Alternatively, some people that are self-employed, some parents that are self-employed, could hire their own children, pay them, and generate that earned income as a way to qualify for the Roth as well.
Okay. Yeah. And at that point, you'd have to pay your child and then tell your child, okay, great. That money is going straight into the Roth. You're not going to be going out fun with that. But yeah, one other thing too that I just recently learned is if you end up having unused money in your 529 plan, that money can then be used to fund the Roth retirement account of the beneficiary of the 529 plan. Is that correct? I see you nodding, John.
I gotta honest, Mike, you may know that specific detail. I gotta say I'm a little rusty on. Certainly, it sounds compelling if it's in fact allowed. There have been a bunch of changes in 2020 to some of these things, and frankly, I personally haven't kept up with every single one. But our team collaboratively usually has a pretty good handle on these things. Mike, do you know off the top of your head?
I have to unmute. There's some specific rules, John, and this is brand new, Adam. So frankly, I need a little more time to be firm about it, but I believe it's up to $35,000 under certain circumstances. Can go from 529s to Roths. I would say talk to us. We actually haven't even done one yet.
Okay.
So
yeah. So I won't put you guys on the spot, but I'll tell folks watching, if you have kids, this is something to look into. As my understanding is, and these are relatively new changes, is that if you end up having excess funds or even deliberately overfund the 529 plan, you can use that to pay for college education, but then whatever's left over up to a certain limit can then be used to fund the Roth IRA of the beneficiary. Now, I believe there's some limitations there. So one, the money has to have been in the 529 plan for a pretty healthy number of years. You just can't plop it in at the last year while they're in college.
15 years, Adam.
15 years. Okay. And, it's not like an and on top of the annual 7,000 limit for the Roth IRA. It goes towards that annual limit. So basically, if you overfund the 529 plan early, you can grow that money tax free. And then, once your kid is out of college, if there's excess funds there, you can then transfer 7,000 a year from the 529 into the Roth. But the benefit for you as the parent putting all this money in early is that it's all growing tax-free. It'll then go into their tax-free Roth, and they'll be able to withdraw it tax-free when they're much older. So something your kids may thank you for doubly. Hey, thanks for paying for my education, and thanks for setting me up in retirement. Okay, we are coming into the last 10 minutes here, folks. Question here from Good Humor Man, who is a stalwart regular of watching our videos every day. I see him on the premiere every day our videos launch. Contrary to his name there, Good Humor Man, he definitely has a pretty pessimistic view of where things are headed. But his question here is a good one, I think, for a lot of viewers here, which is, okay, Mike, you said you could see the markets correcting by 50% or whatever, maybe even more. So however much they correct, he says 90% here, but just whatever the big correction is. Once the shakeout has happened, what do you guys expect from there? Will this be a wonderful time for investing for those that made it through that corrective event with dry capital, and may we have the opportunity to be buying assets at blood in the streets valuations? And it's not all doom and gloom, right? I mean, you guys have some optimism about once we get through the shakeout, there could be really good times here. John, I see you nodding vigorously. I'll start with you, then we'll go to you, Jonathan.
Yeah, well, taking the assertion at face value, a disintegration of over 90%, sure, theoretically, it's possible. We won't ever discount any scenario. Certainly, we might place different probabilities on it. But, it's easy to say, well, if markets dropped over 90%, it's game over. We're all going to be, scrapping for food on the streets or even worse. But the simple answer is if this were to come to pass, I don't think it's particularly the most probable scenario, but simply every bit you can preserve or protect on the downside is being ahead of the game, relatively speaking. It's less of your money you have to have a miraculous recovery just to get back to even. Even losing 50% of your assets, you need 100% subsequent return to get back to even. If you lose 90%, well, geez, I haven't done the math, but it's well over 100%, several 100% probably returns to even just get back to even. So the bottom line is the more you can protect on the downside. And the reality is, yeah, we do think there will be an opportunity here where there's blood in the streets and people will be afraid, not euphoric. And that's the time when you want to be investing. Doesn't mean it'll be easy. In fact, market tops are usually defined by complacency and the feeling like everything is really safe on a short-term and long-term basis. When it feels really safe on a short-term, it probably means it's really risky in a long-term. Vice versa. Go back to 08, 09 in the depths of the housing market crisis. It felt really scary on a day-to-day basis. We were getting 3, 4, 5% swings in the market, but valuations were much more compelling there. So it felt very scary, but it was an absolute wonderful time to be investing, as we now know with hindsight. So we have absolute confidence that there very likely will be an opportunity here before we know it, where there's blood in the streets, but it's going to feel that much more difficult to do so. And that's why we ground ourselves in data and we use tools to mitigate the volatility, make it more of our friend than our foe. But that's our take on the matter.
All right. Jonathan, anything to add to that?
Yeah, I think those are some excellent points. What I would suggest, though, is that in this environment, one of the things we focus on is balance sheets, balance sheets, balance sheets, balance sheets. We make sure we're in companies that can weather a very difficult environment. And if that's the case, then I think what investors need to realize is, yeah, the stock prices can drop in these companies, but you got two things that you can do. Number one, you can use some of the cash and resources you have to buy at a low point in the marketplace, even though that's very, very difficult. It's very gut-wrenching. It's not an easy thing to do. But second, if you're in companies that are well financed and they go into a downturn very, very strong, the businesses themselves that you own will also take advantage of the market drop. And so if you go back in history and you look at some of the companies that really position themselves very well in their industries, it's when there's pressure, when there's bad markets, when other companies have gone bankrupt because of balance sheet weakness and things like that. And so when we're buying companies, we're looking for companies and managers who know how to allocate capital in a traumatic situation. And some of the best returns that we got on our portfolios came out of 08, 09 in the financial crisis, not because the companies we own didn't go down by 50%, many of them did, But then they came out and tripled in value because they were able to buy assets. They weathered the storm. They were the remaining companies. Some of their competitors went out of business. And so that's why it's so important, again, to buy companies with strong balance sheets, good moats. Not only do you dollar cost average, but the businesses themselves that you own will take advantage of the extreme environment that they're in.
Right. And they will likely gain share as their competitors die and be even better set up for what lies ahead. Is it fair to say?
One comment I make. I remember, we've owned a lot of Brookfield assets over the years. I remember Bruce Flatt saying to me one time, this is back in 2009, like 10, I guess, 2010. He said, it's amazing the deals you can get when you're the only bidder. And so when you have the capital and other people don't have it, you can buy things at rock bottom. You had Macquarie in their industry, and we won't go back into too many details, but when basically went under, was really improperly financed. Glencore back in that situation was really badly financed at the time. And they were able to, they had to sell off lots of their streams and royalties to, Franco-Nevada and so forth. So when extreme situations hit, really well-run companies with smart people, that's when they can really make a lot of money for you as investors. Even if you just stay there and you don't do anything, just make sure you're invested with really great businesses.
Yeah, your comments are reminding me of John Hussman's famous, bubble markets force you to make a choice: look like an idiot now, or look like a genius now, or look like a genius later, or look like an idiot now or an idiot later, right? And there's great opportunity at market bottoms, like you just described. But what you have to do is you have to resist the siren song of going all in when at the other extreme, right? And this is where emotions are so hard for us, right? And it's what gets people is to say, all right, I want to go Jonathan's route, and I want to be prudent and safe and be positioned for the downturn. Well, you got to not be fully in at the top, right? And so when you move to more dry powder, and then everybody around you is still riding that wave, and the doubt starts creeping in. Oh, maybe I got out too soon. Maybe I'm wrong, right? You have to kind of pick which way you're going to go, because if not, your emotions will oftentimes get the best of you, and then you'll make the wrong decision at the worst time.
Yeah. Well, if you think of someone like Warren Buffett and the opportunities that have come his way at the bottom of the market, it was amazing, right? I mean, the way he was able to back into Goldman Sachs and also Bank of America and so forth by buying warrants and providing them some capital. So if you have the money when you're in extreme environments, boy, you can buy assets at really attractive prices. And so, but my comment to the retail investors is a lot of times that's very hard for them to do. It's gut wrenching. It's very, very easy for us to talk about it now. And even for professionals, it's difficult. So that's why, you keep a little powder dry, you dollar cost average if things get really extreme, but buy good companies and they will do a lot of the work for you. And they will make a lot of extra money for you if you just stick with really good businesses.
That's very well said. And of course, that's Buffett's model. And if we just want to look at what has Warren Buffett not been doing for the past couple of years? Buying things. Right, he's just been sitting on a mountain of cash, right? So, a lot of people are, saying, why is he doing that? And I think the answer is he thinks a lot like you, Jonathan. He's just waiting for some corrective event to get in at much better valuations. I think it's fair to say, but I want you guys to confirm because I could be wrong. Let's say the market goes down 50%. Didn't even have to get down to the 90% that Good Humor Man asked there. If the market were down 50%, do you guys all believe that the next thing to follow would be tremendous rescue efforts by the central planners?
Absolutely. Yeah, absolutely. They're not going to change. That's my belief.
Okay, so part of this is buying in at good valuations, like Jonathan mentioned, like just the bottom of a market cycle. But part of this as well is positioning yourself there in advance of the expected tsunami of liquidity that would come in and be pushing up asset prices as well.
Yeah, but the problem is this, Adam. We could fall 50%, to roughly whatever that would be, 3,000. And then we could fall another 50% from there to 1,500. Now, 250% drops is a 75% drop. Not predicting it, but it wouldn't really be unheard of in terms of the wide swath of history. In 1929, we lost 89%, and it took 25 years to come back to even. Valuations are at or above those levels. We are in a completely new frontier here. And I don't think this time is different. So who knows what the world will look like if we fall 90% or 70%. Hopefully the system will stay together and that the climax of this fourth turning doesn't completely degrade into something that would be really scary. And we think that the system will probably stay together. But yeah, we fall 50%, we fall 30%, people are going to start jumping in, particularly the T-bill and chill people, and they're going to run out of money potentially before the market bottoms. So you're going to have a plan. 50% down from here is not a screaming bargain based on where we're at.
Okay, wow. All right, well, look, we're going to have to start wrapping it up here, folks, because we're nearing the end of the hour. I just want to give you guys a chance here at the end to give any advice to folks. I know I've talked at length with you, John and Mike, about end of year planning. Jonathan, we haven't had a chance to do that yet, but I know that this is one of those times where sort of a stitch in time saves nine, right? Where if people come talk to you now, there are steps they can take before the end of the year to make sure that they're ending 2024 well, especially if they're sitting on gains, right? So make some intelligent decisions around that. Set yourself up as best as possible for what might happen in 2025. You want to do all that before the January 1st deadline rolls around. Any bits of parting advice on the importance of year-end planning right now? John, we'll start with you.
I think you said John, not Jonathan.
Yes.
Well, yeah. So, the typical race for year end, many things you can wait until next year to do. For example, making IRA and Roth IRA contributions. You have up until tax filing deadlines plus extensions next year to make contributions for 2024. But there are other things you got to get done during this calendar year. For example, Roth conversions, either full or partial Roth conversions, where you can convert a portion of a traditional IRA into a Roth IRA, pay the taxes now at maybe what might be a preferential tax rate. For example, if you're in a low income tax bracket this year and don't expect to be next year, that can make a whole lot of sense. That's got to be done prior to the end of the calendar year to get it done this year. But obviously, booking, realizing losses, harvesting losses for your benefit to offset gains can be very effective. You got to do that before the end of the year. There's a whole laundry list, but there's a couple that come to mind.
Okay. Jonathan, anything else you want to say about, steps people should be thinking about taking right now before the new year arrives?
Yeah, in terms of the Canadian situation, absolutely. We have a situation where our capital gains taxes were actually increased halfway through the year. And there's a $250,000 threshold. So if you're selling, and realizing capital gains below 250,000, then you pay at a lower rate, and if it's above, you pay at a higher rate. So really, there's a lot of tax planning that should be done. So you really should target, if you are going to take some gains in the Canadian situation, to take some gains this year if you're going to stay below the threshold. So there's a number of things like that. That's just one example, but no, I think it's very important for people to just revisit things before the end of the year, write-offs that they need to take, tax, capital gains, capital losses, things like that. There's a number of other sort of registered programs, we call them here in Canada, that investors need to avail themselves to before the end of the year. So absolutely, we're here. Phone us, give us a call. We'd love to talk to you, and we can certainly work through some of the pertinent and some of the timely issues that people need to think about.
Great. All right. And, folks, this is one of those times when a good financial advisor can really be super helpful. In a lot of cases, a lot of these regulations that are out there are not intuitive. I mean, you need to have somebody who actually understands what the current guidelines and regulations are. Some of these things, like, you can take advantage of them between like ages 57 and 62. Even you guys were like, this, that whole 529 Roth IRA thing just got recently updated. We need to go look at it. So folks, highly recommend you navigate this with the guidance of a good professional financial advisor. If you'd like some help from one of the firms that's here right now in this channel, just go to thoughtfulmoney.com. You fill out the short form there, and you can schedule, a free consultation with any one of these firms. All right, gentlemen, looks like from the feedback that folks gave when I asked, they fortunately really do like this format. So we'll continue it going forward, and look forward to having you guys on in about a month. And everybody watching, I'll announce in advance when the next one's going to be in January, so you know to look out for it. But I want to thank you guys for your time and your expertise today, but also just every week in helping everybody watching these videos just become better informed. And as I said at the beginning, it's not just about information, it's about putting that information into action. And you guys are a critical component in helping that happen. So anyways, gentlemen, thanks so much for doing this today. Everybody else, thanks so much for watching. And again, make sure if you would like some help, you fill out the short form at thoughtfulmoney.com, or if you just want to follow us, go there, click the newsletter link, and sign up for our free newsletter. John, Mike, Jonathan, thank you guys so much.
Thank you. Thank you very much.
Thanks for the great questions, everybody.
All right.
Thank you, everybody.
And everybody else, thanks so much for watching.